Everyone, thank you for joining us. Just wanted to put out some ground rules here for you. Um, First of all questions are to be entered into the chat, and questions will be asked throughout the presentations on your behalf. So go ahead and enter those into the chat when you have them. Please make sure your devices are muted. Uh, Thirdly, your questions, if your question is not asked, excuse me, or answered, you will be given speakers' contact information so you can ask them directly after the presentation. I also want to thank all of the PCT reps from Los Angeles, Inland Empire, Oxnard, Ventura, Orange County, and San Diego, excuse me, for inviting their clients and being a part of today's Title Tuesday. Anyone who would like a copy of this presentation, please enter your information into the chat. Please add your name, email, phone number, and your PCT title rep's name so that you can get a copy sent to you. And lastly, please join us for next week's Title Tuesday. We will be having Seth Phillips, Mr. ADU himself, discussing hot topics pertaining to ADU construction, laws, and rules. Look out for that invitation via social media and email in the days to come. Thank you.
Thank you, David. Okay, well, I would like to introduce our speaker. Carol Quan was raised in Los Angeles and graduated from the University of California at Los Angeles. With a Bachelor of Arts in Political Science and a certificate in Business and Administration, Ms. Quan has worked for over 30 years at the Los Angeles County Office of the Assessors. She began her career in 1986 as a real property appraiser trainee and has risen through the ranks in assignments ranging from property valuations to special investigations. She now works in Public Affairs Executive Office under the administration of Los Angeles County Assessors, Jeffrey Prang. So, Ms. Carol, would you like to go ahead and take on the presentation?
Thank you so much, Felicia, for the introduction. And I'm very pleased to be able to share information from our office with all the attendees. I really do miss, though, the face-to-face meetings and for the presentations, and I really look forward to someday when we can once again meet in person and talk about property assessment issues and other concerns. So let's jump right into the program. Assessor Prang really promotes information being given and provided to property owners and to people in the industry. And one of the ways that we do that is through sharing through the Zoom presentations. And we also have our website, assessor.lacounty.gov, that has additional information, access to forms, brochures, tidbits of information that realtors and people in the industry can use in their newsletters. And so I will be touching upon that a little bit later as well. So California is under Prop 13, and that was passed back in 1978. And because of Prop 13, the general levy is set at 1%. And once the assessor establishes a value for the property, that becomes the base value. And that assessment for taxation purposes does not increase more than 2% a year. So when the market's going up 10%, 15%, 20%, your assessed value for taxation purposes increases no more than 2% a year. There's 4 events that can cause a reappraisal. One is when there's a change in ownership, when there's new construction that's been completed, or when there is partially completed new construction as of the January 1 lien date, and also when there's been a decline in value. And so a decline in value, it's just a temporary reduction that can be granted. And that occurs when the assessed value as of January 1 is greater than the fair market value. And the filing period for decline in value is July 2nd through November 30th. Again, this is only a temporary reduction. It's good for 1 year. And then we will review it again the following year to determine if that reduced value will remain, or if we can reduce it further because the market has dropped further, or we can restore the trended Prop 13 value. When we reassess property, more often than not, it will generate supplemental property taxes. Supplemental property taxes are one-time catch-up bills. It's billing for the difference between what was there on January 1 and what the new base is. And so the bills are sent directly to the property owner. If the owner has an impound account, the supplemental bill is not sent to the lender. It is sent directly to the property owner. For example, if a property is sold and a deed is recorded on March 1 of this year, the buyer will receive 2 supplemental bills in addition to the annual bill. And the supplemental, the first one is for the remainder of the 2019 tax year, and that covers the period from April 1st of 2020 to June 30th of 2020. The second supplemental bill will be for the entire 2020 tax year, and that would be from July 1 of 2020 to June 30th of 2021. If a document is recorded August 5th, the second half of the year, then 1 supplemental will be generated, and that's for the 2020 tax year. And when we're working with first-time home buyers, and this is their first experience in owning property and paying property taxes, they bought the home, recorded the first half of the year, everything's going well. And then at the end of the year, they end up with 3 bills. And of course, what typically happens is they panic, and then they end up calling the realtors. They'll call the assessor's office, and they'll say, why did I get 3 bills? I thought escrow took care of my property taxes when I first bought the property. And that's when we need to explain about the supplemental tax bills, and then let them know that the annual bill was still based on the assessed value as of January 1. So it would have been based on the seller's assessment. The supplementals are just one-time catch-up bills. We also have a supplemental estimator on our website. So this is the homepage of our website. The estimator is available as a direct link on the homepage, and it's also in the drop-down menus for the homeowners as well as the real estate professionals. And all we need is a street address or the assessor identification number. You would click enter, then put in the recording date and the purchase price, click enter again, and the estimator will let that person know what the estimated supplemental taxes will be. And when we're working with home buyers, whether they're first time or they own many properties, it's always good to know what to anticipate and to make sure that you have the monies set aside to pay the supplemental property taxes. Let's jump into some of the exemptions and exclusions. So the most basic exemption is the homeowner's exemption. It reduces your taxable assessment by $7,000, which results in a $70 savings on your property tax bill. It's just a one-time filing. We do require the Social Security number or the tax identification number of the applicant. If the property is owned by husband and wife, then we need both their names on there as well as their Social Security numbers, signed and then sent back to our office. Once the homeowner's exemption is on the property, it stays on there. They don't have to file every year to get that homeowner's exemption. There is no charge to file. In fact, the form is also available on our website, assessor.lacounty.gov, but we automatically send that claim form when residential property is acquired. There's also the disabled veterans exemption, and this is for disabled vets who are blind in both eyes. They've lost the use of 2 or more limbs and are totally disabled as a result of injury or illness incurred in military service. They must be rated 100% disabled by the Veterans Administration. And to receive the full exemption, they must file by February 15th, or they can receive a partial exemption if they file after that. And the same goes with the homeowner's exemption. To receive the full $7,000, they need to file by February 15th, but for 2020, they can still receive 80% as long as they file by December 10th. The disabled veterans exemption is much greater than the basic homeowner's exemption. It starts at 100,000 for the basic exemption and 150 for the low income disabled veterans exemption. And it is adjusted annually for inflation. For 2020, the basic disabled veterans exemption is 143,273. The low income disabled veterans exemption was 214,910. But to qualify for the low income disabled veterans exemption, their household income cannot exceed 64,337. There is a schedule out for the 2021 exemptions as well. So a disabled vet who qualifies can save anywhere from $1,400 to $2,100 off their annual property taxes. Once they receive the disabled veterans exemption, for the basic exemption, they do not need to file every year. It's automatic, it just stays on there and it's automatically adjusted. For the low income, they do need to file every year because they need to report their annual income so that we can determine if they still qualify for the low income exemption. If they no longer qualify for the low income exemption, then it will automatically default to the basic disabled veterans exemption, so they don't lose out on it. The one issue, or one of the issues that we receive a number of calls and emails on, is the parent-child exclusion. I said earlier that anytime property changes ownership, it is subject to reassessment. But if this is a transfer between parent and child, it can go from parent to child or from child to parent, and the property is owned by either the parent or the child. Interests in legal entities like an LLC or corporation do not qualify for this exclusion. And there is a limit of $1 million per eligible transferor, but the principal residence, which is a property that's eligible for the homeowners or disabled veterans exemption, will not count against that $1 million limit. And so this can be a huge tax savings for the children, but this is not an automatic benefit. They need to apply for this relief. If they qualify for it, then they can receive it. We get a number of calls and emails where the property has passed on to the children, and the children within a year or so sell the property and they never take advantage of the parent-child exclusion. So we will reassess as of the date of transfer from the parent to the child. Because there's no claim form filed, we'll reassess it to the fair market value. And if the property is already sold to a third party, then the child will end up with an unsecured property tax bill. And depending on when it's sold, they'll receive an unsecured bill for the transfer, supplemental reassessment, and then possibly for an escape for the year. And so when it's an unsecured bill, it is not a lien against the real property. It becomes responsibility of the person whose name is on the unsecured bill. And we have a number of cases regarding this. And in fact, I had a case a number of years ago where the children had stayed in the house. The parents had died. The children stayed in the house. 10 years went by, and the children decide to refinance. So one, we never knew that the last parent had died 10 years earlier. The property was in the parent's trust. And so the children thought that, hey, it stays in the trust. We haven't taken it out. They didn't realize that the death of the parent was a reappraisable event. So what they did was they refinanced 10 years out, took some cash out, and that's when we discovered that 10 years earlier, the last parent had died. There was no claim form on file, and we were never timely notified. So we reassessed the property as of the date of death. And because we were never notified by the filing of a change in ownership statement, death of real property owner, the children received a total of 8 bills for the escape taxes. So they received the notice of supplemental or escape assessment. Then they received 4 bills for the years that the property escaped paying taxes on the higher assessment. And then about a month later, they received another set of 4 bills. So in total, they had received over $56,000 in escape taxes due to the date of death reassessment because they did not notify us and because they did not file for the parent-child exclusion. And the filing deadline for parent-child exclusion is 3 years from the date of transfer or before the property is sold to a third party. However, a claim may still qualify if it is filed within 6 months of the mailing date of the notice of supplemental or escape assessment. And in the case that I was working on, yes.
Sorry, I do actually have a couple questions before you go any further because it's about the, one is about the affidavit of death. So on a parent to child exclusion, can you add a grandchild to title without full transfer?
So let's say property is owned by A and B. A and B transfers to A, B, and C, all as joint tenants. Then as long as A and B are on title still and the property is held in joint tenancy, then typically there's no reassessment. So it depends on the vesting as well. So that means if grandma is the only owner on title and grandma transfers to grandma and granddaughter as joint tenants, then typically there's no reassessment. And before I continue further, I should give my disclaimer. I am not an attorney, estate planner, accountant. So, I'm not giving any legal advice and I can't tell people how to structure documents or how to phrase certain things, but this is just information for educational purposes only.
Okay, perfect.
Did that answer the question, Felicia?
I believe so. And the second question we have is, why does a property get reassessed when an affidavit death of trustee is filed?
So it's reassessed because when an affidavit of death of trustee, if it tells us that if the trustee was the owner of the property and the owner has passed away, even if the property remained in the decedent's trust, death is a change in ownership. And that's why it gets reassessed when an affidavit of death of trustee is recorded. And that's the example that I was sharing, in that the father and mother had their property in the trust, but both parents died and we were never notified. And the only time we found out that the last parent died was when they did a refinance. And so when you refinance, they probably had to take the property out of the decedent's trust. And to do that, they also had to record affidavit death of trustees. And that's when we discovered that the last parent had died.
Thank you.
Mm-hmm. Okay, and also for Prop 58, a child may be the son, daughter, son-in-law, daughter-in-law, stepchild, while that step-parent, stepchild relationship exists, or a child adopted before the age of 18. But to end the story that I was sharing, they had a happy ending. They contacted our office after they received the 8 bills, and we explained to them why they received it. They submitted the Prop 58 claim form and a copy of the entire trust, including amendments, to our office within 6 months of the mailing date of the notice of supplemental or escape assessment. And I mean, because they've already gone beyond the 3 years, it's over 10 years now, but they got their paperwork in within the 6 months of the mailing date of the notice. And the notice is a form letter. That's when the clock starts ticking. They don't have any 3-year deadline. They've already missed that. Now they only have 6 months, and the document has to be in-house within 6 months. It cannot be in transit on the last day. And so they got the claim form and the trust into our office timely. We were able to review it. It took us several months. In the meantime, they had to pay the taxes, but happy ending, their claim was approved. We were able to reverse that reassessment going all the way back to the date of death. And so they got the monies refunded, less the homeowner's exemption that was attributed to their parents. So they didn't get back about $600 or so. But it's a huge tax savings for them. Otherwise, they would have lost out on $50,000 in property taxes. Now, let's say they filed the paperwork, let's say month 8, we still would have approved the claim, but it would not be retroactive. It would only be valid from the year they filed going forward. So they lose out on a huge refund, but at least going forward, they can pay less taxes. There's also the grandparent-grandchild exclusion known as Prop 193. This is one way only. It can only go from the grandparent to the grandchild, only if the parents who are considered the children of the grandparents are deceased. And it has the same filing deadlines as Prop 58. So I've already covered that. Again, to touch upon this is that when a property owner dies, we are to be notified within 150 days of the passing of the decedent. And how we are notified is by the filing of a change in ownership statement, death of real property owner. That form is also available on our website. They can download it, fill it out, and send it into our office. But if they're going to do that and the property was in a trust, then these are the documents that we would need to update our records upon death. So we would need that change in ownership statement, that the property owner, a copy of the death certificate, a copy of the entire trust agreement, including any amendments, and the Prop 58 193 claim form, if applicable. So if all those documents are sent to us all at one time in a timely manner, or at least before the property is sold to a third party, it can avoid a lot of the headaches down the line. Because I'm sure you probably work with clients who maybe a year or so after you've helped them sell the property, they're saying, hey, I just got these unsecured bills, and what are they for? I mean, the property stayed in the trust, we sold it from the trust, and so why am I getting these unsecured bills? And if this was property that they had inherited upon the death of their parents and they never notified us, they never filed for the Prop 58, more likely than not, it was due to the date of death reassessment then.
Hi, Carol. I have a question for you. We have a question from Chris. Can Prop 13 be transferred without reassessment?
Can Prop 13 be transferred without reassessment? Are you saying can property be transferred without being reassessed, right?
Right. Through,
So,
through Prop. Yeah, that's, I read it right off.
Under Proposition 58 193, property can be transferred from parent to child and not be reassessed. So the child can keep their parents' Prop 13 if they apply for the parent-child exclusion. But again, there is a limit of $1 million per eligible transferor that can be excluded from reassessment, and the principal residence will not count against that million. Let me give an example then. Let's say my mom owns 3 properties, her primary residence and 2 apartment buildings, and she just gives everything to me. She doesn't have to die, she just gives everything to me. I would file a parent-child exclusion on each property. Let's say the principal residence, of course, has its homeowner's exemption, so that's approved. We'll set that aside. But the 2 apartment buildings, the current assessed value on assessor records show $400,000 each, and I filed a claim for each one. Because the sum total is less than $1 million, both of those apartment buildings can be excluded from reassessment. So I continue paying taxes on $400,000 each versus, let's say the fair market was $2 million each. So I'd be paying taxes on $800,000 versus $4 million. Again, that's a huge tax savings for me as a child. But of course, I would need to take advantage of it. And again, interest in legal entities like an LLC or corporation will not qualify for this exclusion. But there is a ballot measure coming up known as Prop 19, and I'll touch upon that when I go into the Prop 60. But did that answer your question, David?
I think so. I think I just, I read it right off the screen, so I'm assuming that's what they were.
Okay, well, I'll continue on, and if they still need clarity, we can discuss.
Thank you, Carol.
Okay, so Prop 6090 is known as the Senior Replacement Dwelling Benefit. And this is for seniors who are 55 years and older who want to transfer their Prop 13 value from the original to a replacement. Now, this is a one-time only benefit. Husband and wife are deemed to have used it together. And so they must own the principal or the primary residence, must be eligible for a homeowners or disabled veterans exemption. They must sell that property and acquire a replacement property of equal or lesser value within 2 years of the sale of the original. And then they need to file the claim for base value transfer within 3 years of acquiring the replacement. If they meet all of the requirements, then we will be able to transfer the trended Prop 13 value from the original to the replacement. This provision, the requirements are very black and white. There's no gray area. You must meet all of the requirements or your claim is denied. You must meet the age requirement. You must sell the original. You must acquire a replacement. The acquisition must be within 2 years of the sale. It can be 2 years before, 2 years after, and you must meet the equal or lesser requirement. And the law requires that at the time you sell the original, the claimant must be 55 years or older. And if you're working with a client who is 54 years of age, 11 months and 25 days, and you're set to record the sale of his original property, and he's looking to file for the senior replacement dwelling benefit, he really needs to understand that in order for that original property to be eligible, in order for him to be eligible to take advantage of it, he must be at least 55 years or older at the time he sells the original property. So the age requirement is critical. He can buy the replacement before he's 55, but at the time the original was sold, the claimant must be 55 or older.
I have a question.
Yes.
From Brian. For the seniors benefit, what if you bought a property out of the country to retire at?
Well, out of the country, this is only for California, the state of California, and it's not going to benefit at some other country.
So would it transfer to different counties? Would that be okay?
Well, there's only 10 counties in the state of California that have a Prop 90 ordinance in place, meaning their county board of supervisors adopted the provisions of Proposition 90. And so there's 6 in Southern California, 4 in Northern California. We've got Ventura, Los Angeles, Orange, San Diego, Riverside, and San Bernardino. And in Northern, it's Alameda, San Mateo, Santa Clara, and Tuolumne. Counties can opt in to the program. They can opt out. Before you sell and buy in a county outside of the county you reside in, you need to check with that assessor's office to make sure that they have a Prop 90 ordinance in place. I mean, you can buy in that county, but if they do not have a Prop 90 ordinance in place, they will not accept the base value from the other county.
Thank you.
And so there is a ballot measure coming up in November known as Proposition 19, which would basically expand Proposition 60. It would eliminate the equal or lesser requirement. It would allow the senior to transfer the base up to 3 times, and it would be throughout the state of California. But on the flip side, regarding Prop 58, it would eliminate the $1 million exclusion on other property for transfers between parent and child, and for the child to benefit on the primary residence, it would have to be occupied by the beneficiary, by the child. So in order for the child to be able to get that Prop 58 on their parents' primary residence, they would have to occupy it as their primary residence. So that's how Prop 19 would affect Proposition 6090, as well as Propositions 58-193. And that's coming up in November.
Okay, I have another question from Kim.
Sure.
Do both parties, married couples, have to be 55 and older?
No, only the claimant needs to be.
Only the claimant needs to be. Okay, perfect.
But again, husband and wife are deemed to have used it together. So let's say the husband's 60 and the wife is 40, and the husband claims the Prop 60 benefits. Maybe later on, husband passes away, wife is now 55 or older, and she wants to transfer her base, take advantage of 6090. she will not be able to do that because she already took advantage of it with her husband. And also, let's say she marries someone who wants to take advantage of 1690. They're married and they acquire property together, and he wants to take advantage of 1690. He won't be able to either because she already took advantage of 1690 with her former husband. And if we're dealing with divorce situations, and let's say both husband and wife are over 55 and they get a divorce and they sell the property, who gets to take the base? Only one person can. It can't be split. And again, this is a legal matter. They should work it out with their attorneys.
Thank you.
Okay. Now, lastly, I'll cover Prop 110, and this is the disabled resident exclusion. And basically, it's the similar requirements as 1690, but it allows someone who is severely and permanently disabled to sell their primary residence and acquire replacement of equal or lesser value within 2 years of the sale of the original. And the replacement will be to accommodate their disability and to alleviate the financial hardships due to their disability. And there's no age requirement, it's a disability requirement. And even if you took advantage of 6090, you might be able to transfer the base value a second time under Proposition 110. So let's say I take advantage of 6090. 5 years, 6 years later, I become very ill. My replacement home happened to be a 2-story townhome, but I became very ill. Let's say I'm in a wheelchair now. Well, this 2-story townhome is not going to work for me. So at the time I took advantage of 6090, I was whole and healthy. I was fine, no issues. But it was after I took advantage of it, I became severely and permanently disabled. I can sell that 2-story townhome, buy a single family residential property of equal or lesser value, and get a physician's certificate of disability and file the claim for base value transfer under 110. And if I meet all the requirements, the assessor will be able to transfer the base one more time from that 2-story townhome to my single-story single family unit. And again, the requirements are listed on the claim forms, and it's also available on our website, assessor.lacounty.gov. Another resource for information is with the Board of Equalization's website, known as boe.ca.gov. They have a very robust FAQ section, and it does cover a lot of scenarios with Props 58, 193, 6090, and 110.
Carol, going back on Prop 19, they're asking just to confirm, Prop 19 does allow you to transfer 3 times, correct?
You can transfer the base up to 3 times, but I don't know all the details. So especially like if they didn't have the equal or lesser requirement and they buy a property that exceeds that limit, I mean, how does that all work? And so we will have a lot of implementation legislation that, should it pass, that we would have to look into. So, but I'm just trying to give an overview of what that proposition covers. I would encourage you to read up on it to get more details.
Perfect, thank you.
And also, let me touch upon the fires that are going on. If you know of folks whose property have been severely damaged due to misfortune, calamity like a fire or an earthquake, and the damage, I believe, is more than $10,000 in damage, then they can go ahead and file for misfortune and calamity relief. And that claim form is available on our website, assessor.lacounty.gov. And they have 12 months from the date of damage to file for that relief.
Okay. Can you, Carol, touch up a little bit on Prop 15 for us, please?
Okay, let me do a stop sharing on the screen. So with Prop 15, I I think the formal title is like Schools and Communities first. And it's a split roll ballot measure where, should it pass, the assessor's office would reassess commercial industrial properties to fair market value. And it would be done about every 3 years. And so if you've got an office building, then, and you've got tenants in there and your tenants have a triple net lease, when that office building gets reassessed to the fair market value with a triple net lease, more often than not, the landlord will probably pass on that tax increase to their tenants. But it's more known as a split roll, and it affects commercial industrial properties.
Gotcha.
Mm-hmm.
And I see a question in here. It's saying, let's see, from Lauren. If you sell for 1 million, buy at 1.3 million, then they pay increased taxes to paid on the 300K, is her understanding. I'm assuming when they purchase over $1 million.
Are we talking about Prop 6090?
I believe so. Or it could be
Prop 19, the new proposition.
So with Prop 19, okay, that's the 6090 and the 58. Again, I'm not quite sure how with the working, the implementing legislation and all that, what the instructions will be for the assessor's office. I'm sure it's going to be a very interesting math functions and operations for us to do when we try to figure it out.
Okay, so I think that's that kind of wraps it up. Carol, thank you once again for your for helping us out today on Title Tuesday. You were excellent. Any questions that may have not been answered that you need answered, Carol put up on the screen her contact information. You can go ahead and email her as well as give her a call to the assessor's office. Thank you again, Carol. You've answered a lot of questions for us, and I think we've got to do some research on Prop 19 that's coming up on that ballot. So thank you again, Carol. There's nothing else, Felicia, up on the board, correct?
Do people have any
Yeah.
issues regarding property information? What's new construction that's subject to reassessment and all that? So they're all good?
Did you want to touch on that, Carol?
Well, we do get calls from folks who say, well, the assessor's square footage and room count's different from what's out there, what's actually out there. And so they want to update their building information. We do have a form available on our website. Do is fill it out and send it back to us, and that can be done online. Property data change request. So we can update the building information. And
Carol, I got a question similar to that. I have a transaction where the homeowner's been on title for the past 4 years, but the tax roll is still showing the previous homeowner. I've called, they put me through the title department of it, and then I get voicemail. So what process does a homeowner have to go through to get that changed, and how quickly can it be changed to their name in order to be able to sell or refinance their property and show their name on the tax roll?
wow. You have my contact information. If you could email me the information, the property, who the owners are, and what document was recorded for the transfer, then we can look into it and see why we didn't update the ownership. So you have my contact email, cquan@assessor.lacounty.gov.
I do. Unfortunately, it's for Riverside County. So yeah, I don't think you could help me on that, correct?
I'm sorry, I can't. You will need to email the Riverside County Assessor's Office on that one. And just to let you know, even though the county buildings are closed to the public, we are working here, the Assessor's Office, the employees are working. About 85–90% of us are teleworking. I am at the I'm at the building though. So I'm at the hall, so I do come into the office.
Perfect. And just a quick reminder to everyone too, please put your name, rep name, as well as your email address if you'd like a copy of this recording.
And just to remind everyone, next week's Title Tuesday is Mr. ADU, who's going to be going over some changes in the ADU process throughout California. So join us. Look out for that link from your rep, as well as on social media or via email. George Mesa is not on here today. He's actually having a procedure done, so let's all keep him in our prayers. And he did want me to mention to you guys, any type of farming, please reach out to your reps. Absentee owners are the name of the game right now. So reach out to your PCT rep so they can go ahead and get that generated for you and help you obtain some business out there. Once again, thank you, Carol, and thank you everyone for joining us today. We really appreciate it, and I hope this was very, very informative. I know it was very informative for us. So thank you once again.
Thank you, Jorge. Thanks, everyone.
Thank you.
Thank you, Carol. Anthony, are you there?
Yeah, I'm here. What's up, buddy?
When you send out the recordings out to us, can you include the chat so we can see the names of those who requested?
Yeah, yes.
I know
Carol, would you like a copy of this as well?
Sure. Yeah, that'd be great. Thank you.
Great.
Do you
Yeah,
need
that
me
was-
to email the PDF of the presentation, or did I already do that in the past? I think I did.
You did in the past, but if you could go ahead and email it to me just in case.
Okay.
That way we can get it out to everyone as well.
Okay, I'll send it as a PDF.
Great, thank you.
Mm-hmm.